Adam Lerner with McNally Capital. I represent a firm that is a private equity firm backed by a family. So the McNally family sold the Matt Business ran McNally Companies back in 1997, which is the event that created their family office. Maps and publishing and printing of airline tickets were their primary businesses. And the family wanted to continue to own and operate small private companies, and so they started investing out of their family office in different industries, energy, industrial, and healthcare. What they quickly realized is they were very different than publishing, and so what they would do was go out to some of the other families that they knew that made their wealth in those particular industries to serve as value-added partners, not so different than what we're talking about here. In 2008, they basically spun that activity out to a separate firm that would be McNally Capital, where we could broaden that experience to some of the other families that we had gotten to know. I joined just after the firm was founded, where we had about 40 or so family relationships that Ward, who was a sixth-generation McNally family member, had generated. We've got our interesting differentiation and strategy in the market today is we know over 1,000 family offices that we interact with on an ongoing basis in different ways, whether it's to advise them on some of their strategies or for them to invest with us. But the way we operate is not so different than a traditional lower middle market private equity firm. We're somewhat generalist, though we focus on aerospace and defense, industrial products and services with a little bit of technology sprinkled in there, as well as business services, 5 to 30 million in EBITDA. And we really like to find great management teams and executives to partner with where we can help build strategies. As we'll talk about in this panel today, there are some firms that execute a strategy where they come in and drop in their own management team, replace management. That's not our strategy. And we are looking to find great executives that have an investment thesis with whom we can partner. We also can do control, minority, debt, equity. We've got a lot of flexibility. We've got great family partners. And I'm happy to be here today. This is my first time at this conference. Thank you.
All right. Hi there. Yeah, my name is Alex Wells with Union Capital. I'm the Director of Business Development there. Union Capital was founded back in 1968 in Chicago. We're generalists. We don't really do anything in tech or healthcare, but otherwise a lot of specialty manufacturing, food manufacturing, business process outsourcing, franchises, industrial staffing. Bite size, sort of 3 million EBITDA all the way up to 20 million EBITDA, but I'd say our sweet spot is more in the sub 15 or sub 10 EBITDA. Excited to be here and learn more about all your theses and see if there are things we can work on together. Thanks. Attended before, yeah. I think this is my fourth or fifth. Coming back, definitely. Absolutely. Yeah, absolutely. I mean, I think, a lot of what we do is partnering with executives, partnering with business owners, and helping them take business to the next level. So this is a great fit for us. Thanks.
Hi, my name is Reid Peterson. I'm with Avego Healthcare Capital. It's my first time here. Excited to be here. Avego is a private equity investment fund based in Atlanta. We also have an office in New York. We back businesses anywhere between 3 and 15 million of EBITDA. We also have another model where we've backed entrepreneurs going out and finding companies and kind of giving them a salary when they go look for acquisition targets, which is a little bit interesting, a little bit different than some of the other folks in the room. We really see ourselves as backing entrepreneurs. So we ourselves are like more of a boutique fund. We see ourselves as entrepreneurs, and we really see ourselves as partners with other entrepreneurs. We're very active in the pharmaceutical space, healthcare services, and pharmaceutical services.
My name is Jeff Gonyo with Geneva Glen Capital. We're local here. We are a private equity firm, but single family office, so a little bit different than Adam's firm. We're multi-families. We have a single family. It happens to be actually one of the wealthiest families in China. Their U.S. headquarters are here in Chicago. The company's called Wansheng. It's about 25 billion in revenues, and we've been working with this family for 10 years now, and they're great partners because we don't have a fund structure. We can be more patient capital. We don't worry about investment cycles and raising funds, and we you know, seeing if money's available. It's readily available, anywhere from like typically 10 to 75 million per investment. Usually it's equity, but we'll do mezzanine with equity. We've invested in 5 companies to date. Pretty eclectic mix. We have a frozen bakery business that makes great cheesecakes that you find at a restaurant. We have a home healthcare business in Philadelphia. We have a logistics company in Los Angeles, chemicals business in Cleveland, and a playground equipment company in Denver. So what's a common thread? It's typically the reason we're here is to meet operating executives who have very strong, relevant domain expertise that can serve one of 3 capacities. One, either to run the business full time as a CEO. 2 would be to be an active board member. Or 3 is a hybrid, like our home healthcare business, where executive is an active chairman or chairperson. In that case, he's half time, and that's the right amount of involvement for him. He has a wealth of knowledge. We're all about successful track records of executives and relevant domain expertise, and that's where that's where the intersection comes from. So whenever when we talk today, I'm most interested in your backgrounds and what you've done in the past. The theses are great, but we really value that you've been there and done that in a certain industry, and we have a high degree of waiting for that, as well as your track record. I would agree with Bill's comments too, in terms of we're definitely lower middle market, not bigger companies, but somebody who's hands-on. I met a fellow named Rick Andersman at the JP Morgan Healthcare Conference in San Francisco about 6 years ago, and he was president of a company called Kindred at Home. It's a division of Kindred Healthcare. It's a $5 million company. It sold recently in private equity. But he left there. He was in transition, maybe similar to a lot of you in the room. And he was looking to buy either a home healthcare business or a hospice business as a platform. We canvassed the market. We contacted a lot of investment banks. He ended up hearing about an opportunity, or actually reconnected with a former target of his that he had pursued at Kindred, a company called Southeastern Home Health Services. And the timing was great. He caught them at the right time. They didn't hire an investment banker. They had 2 inquiries from strategic buyers, but the 2 owners of the business were intrigued with this concept of recapitalization, where they could maintain a 20% stake in the business. Rick, they knew Rick from the past. They respected him. He came in as active chairman. I think it was very important. I mean, ultimately, we weren't the high bidder in terms of price, but the fact that they could roll over equity felt good about Rick. Rick lives in St. Simon Island, Georgia, and the company's in Philadelphia, so they knew he wasn't going to micromanage them, but he lent his advice, his counsel, from being in the business for probably 30 years or so, and right, exactly, and the CEO is still there, as well as the COO. They're the same people we backed, and they'll probably make more money on their rollover piece than they did on the original. Yes, exactly. Right, the bite's bigger than the apple itself, so it's good. Rick has a wealth of knowledge in hospice, which is it can be a very good business if you have enough scale, but it takes a while to get to that scale. But we have a strong referral base with all our home healthcare patients that we could rapidly grow into hospice. We wouldn't be able to do that. We wouldn't do it otherwise, but it's essentially a cross-selling. You can think of it as a cross-selling opportunity, but it's referral based. It's all reimbursed by CMS, which is essentially the government Medicare. Probably Bill Kidd and Peter Wright are the only 2 in the room that may have been here more than me. So maybe 10 times or so, I'm guessing.
Yeah, I think coming from a family office, coming from working with Ward and his dad over the years, I think what we've come to appreciate is just a slightly different perspective. It's the combination of an owner-operator perspective combined with investment expertise and the idea that you want to compound wealth over time, and the intersection of those 2. And I think it's, for us, that is part of our culture is what's made us, I think, very successful partnering with executives, both the family offices that have made their wealth in particular areas where we're looking to invest, and then also finding owner operators that want to continue with us. One of the attributes that's really important to us is continued rollover and reinvestment in the business, and I think that's not necessarily uncommon. But having that alignment combined with our just overall oversight and approach to management and governance, I think is what's allowed us to differentiate. And I'll say, I think the industry overall, especially in this part of the market, has probably got a little bit of a bad rap when you look at Wall Street. And at the end of the day, at this part of the market, you've got different firms that focus on strategies and partnering with management teams, partnering with founders. They know what it means to transition a business from one generation to another. They know what it means and what it takes to build value and build growth. So a lot of the stuff that you hear just isn't true at the end of the day. Now you have to, as much as anything else, you have to evaluate your partner, the way they operate, the way they function, and whether you and their goals, your goals and their goals are aligned. That is one of the most important things. We talked in the last panel a bit about what it means to evaluate the right private equity partner, and I think in going through that process for you, I think is one of the ways you can mitigate some of the risks. So not all firms will be aligned around what you want to accomplish. Maybe there's a firm out there, whether it's us or someone else, who doesn't want the son to take over, right? In which case they're probably not the right partner for you. That's the goal. So there's a whole process that you can go through, being upfront and transparent throughout the diligence process, where it isn't just information sharing around financials and quality of earnings and legal documents, but it's about strategic vision and goals. And that goes both ways, frankly. And that's the way that we tend to approach our partnership with management teams. So while some of the myths are true, they exist out there, I think they're probably more the exception than the rule in this part of the market. There are certainly ways as you go through your process. Yeah, I think structurally speaking, it's certainly more difficult. Yeah, for us, it means a couple of different things. We look for opportunities where the business owner can invest with us. We have a structure where the founding members, the family, the CEO invests in the same security as we do. That for us is important. So I could look in the eye and say we're all on the same playing field. We'll do debt, we'll do equity. Even on the debt side, we offer that opportunity to invest in with management teams. The other thing we'll do is during our diligence process, we'll actually go through an early version of our strategic planning process, so that doesn't start 108, as part of the 180-day plan post closing. It starts even during diligence, so that we can make sure by the time we close that we're directly aligned around what we want to do with the business, what we're going to do in particular in the first year, because there's so much that needs to get done. And I think that process for us is what allows to create this partnership approach and partnership mentality. The other is to talk about what happens when things go bad, either with our existing businesses or what we see potentially that could come down the pike for the businesses that we're evaluating, and what the management team's experience has been in the past as well. And I think going through that has allowed us to create an environment with a team where at least everybody knows how each other would behave in certain circumstances, and they're financially aligned and strategically aligned around what we want to do with the business, even before we close.
Yeah, absolutely. I mean, I think, for us, when we approach a business owner, we sort of try to be solution providers. There's, some business owners where, they're 42 years old and they, have reached a plateau, but they really want to grow the business, and that's great. We want to support that. And there's, other business owners that might be 78 years old and they're, ready to head to the golf course, and we work through that too. So I think, a lot of times the benefit, broadly to having private equity come in is that, the same person that took a company from $1, to $50 million of revenue, may not have the right skill set to take that from 50 to 100 or 50 to 150. And what we sometimes find, and what sometimes makes it fun is, business owners found some amazing niche or, some sort of something in the market that they exploited and built this amazing business. But most people aren't good at everything. So there might be, they might be amazing in operations, but they hate sales. So, for that reason, their operation stuff is good, but they're not really doing as much as they could on the sales side, or the reverse. So, in partnering with business owners, a lot of times we say, look, what's the thing that's bothering you? Let's figure out a way to have you not do that anymore. Look, we'll hire a senior salesperson. You just run operations, or the reverse. You love selling things. Look, we'll get a plant manager in and do that. So I think, we're really all about trying to support, the management team. Whether that's with, operational metrics, or anything we can do to be helpful. And I think, particularly for executives, we're proud of, been doing this for 50 years, and a lot of the CEOs that we work with as who run our portfolio companies, once we've sold that portfolio company, they decide they'd like to come along and work with us on the deal execution side afterwards. So we think that's a good sign. While we're doing these sort of transactions frequently, this is they sort of only have this one company they may have worked on for their whole life. So even if even without the sort of bias around private equity, and even if they're financially sophisticated, it's it's a nerve-wracking situation, because if they're smart, they realize on the other side of the negotiating table there's someone who's done this all the time. So I think it's trying to build a good relationship, trying to build a good partnership, because for us, for most of the deals we do, we're coming in as a partner with the business owner, and we're going to try and help them grow the business. And so we're really, looking for partners there. So trying to build that relationship and being aware of that dynamic.
So I think we try to invest in companies and hold them for anywhere between 3 and 7 years, which is a pretty standard, typical private equity strategy. We're really more growth investors. So to somebody's point on the last panel, we use some leverage, but we tend to underlever our businesses and really look for transformative growth rather than just gaining scale, paying down debt, and selling off. And it's worked really well for us in the past. And a key part of that when it comes to these entrepreneur-owned businesses is really getting alignment with the sellers prior to closing, understanding from them what their needs are, to Alex and Adam's points, but also level setting with them. This is what it's going to look like, and things are going to change. And so, a lot of the time, it's a very emotional experience for them, because they're selling something they spent such a large part of their life developing, and managing those kind of emotions when things go wrong is, I think, a key way we've been able to differentiate ourselves and kind of developing the reputation that we have. And the other thing I think is just having an entirely referenceable executive base, and going to the sellers and saying, look, we would encourage you to reach out to all the executives we've worked with, and not only ask them about kind of what we're like, but also how do these people act when things go wrong, and kind of what's that process look like, so they can just be sure, even prior to closing, that they make a fully informed decision and are really comfortable with what they're getting into. I don't think it has to do with the size of the current company per se. A lot of it has to do with what's changing in the market that is going to drive growth going forward, and how can we lay in acquisitions where, to some of the points that were made on the earlier panel, where 1 + 1 is 4 or 5. And in healthcare, one way you do that is taking company, to Jeff's point, in home care and hospice, and kind of taking revenue that's going out the door from one type of company and capturing it in a type of referral relationship between two companies that you put together. There are also other dynamics where there's a change in reimbursement that allows you to get more growth from doing one type of thing well, or pursuing one type of acquisition versus some other types of acquisition. For example, in home healthcare, there's been some changes on the kind of the therapy versus care mix with CMS. So we know if we're acquiring companies that do more on the therapy side, there's probably going to be less growth there than on kind of more care-driven strategies.
Because we're a family office, we don't have like a defined investment period. We target 5 years, similar to Reid, 3 to 7. It's great. We'll sell whenever is the optimal time to sell, but we're not driven by our own fundraising cycles of having liquidate companies for the sake of having a nice, top quartile return in our offering memorandum to go stay in business and raise our next fund. So it's a nice situation to have. Of course, we have all our eggs in one basket with a Chinese investor, and who knows what's going to happen in China. But whether it's tariffs or viruses, and I think they'll get through that. But certainly, it's a little different model there. But it's we don't have the grind of fundraising every 3 or 4 years. And I guess one thing I would add, I'm answering your question, Elena, but certainly industry knowledge, like Reid's firm, they're very deep in one sector. Obviously, we're generalist. We value that. We also tend to we have the flexibility to pivot where we think it's the right time in the economic cycle. Having started doing this as Geneva Glen back in '08, I will tell you during the last recession, it was great, but it was horrible in a lot of ways. One is we just come off with very high valuations in like 2007, 2006, and therefore when a recession hits, there'll be a reduction in deal activity. But also sellers will say, I should have sold. Right now is a great time to sell. Everybody wants to sell, but my fear is just volume will dry up for whenever the next cycle hits. It will hit. It's inevitable. But what causes that? Who knows? But that's where having some patience and being able to maybe be flexible in terms of industries is helpful. Healthcare is a great sector. It's fairly economically resistant. We like consumer and food. It tends to be pretty stable. I know some of you have backgrounds or interest in building products or construction. We're avoiding those right now at the moment just because it's tough to say what inning we're in there. And when even if the housing cycle isn't like it was in the last recession, that's tough. So we tend to be fairly focused on economic cycles. How did the company do fare in the last recession? That's important for us. Well, I think I won't speak for the whole panel here, but we're hopefully building quality companies that are more valuable. And I think Bill Kidd has mentioned before in the past. We're trying to take businesses and build great management teams, and whether we sell to a strategic buyer or another financial investor, it depends on the situation. It could go either way. We want to build a quality company, so sustainability will continue to exist. Diligence processes are fairly exhaustive, and it's hard to just flip something that's a house of cards. People are just the industry's matured too much. People have been burned in the past by flippers of businesses or things that are maybe just aggregation of companies and they're not really integrated together well. There's not a quality management team. There's not depth. There's so many private equity firms today that there's a very liquid market to sell to other private equity firms. That wasn't always the case. People were more snooty, like, I'm not going to buy it from another private equity firm. All the juice is squeezed out of it. But now people look at it and say, it's been battle tested. They built, they have great management team. They have a new CFO. They got great systems. That is, if you're talking about sustainability in terms of, I assume you're not talking about in an environmental sense, but more just, are you building a quality company? You will get rewarded for that, I believe, when you exit.
Think about it in terms of the growth plan that we're executing with the management team and how long that takes to execute, right? So typically for us, it takes about anywhere between 3 and 7 years to execute the strategy we had set out to execute. And at that point, you think about what the next phase of growth is for the business and who the right partner is at that time. Sometimes it could still be us, right? But in many instances, the business is bigger. For example, maybe you had an opportunity to expand, geographically, in the U.S., but the next opportunity is global, right? You need a partner for that. And so that's the way we kind of think about it in sort of vignettes, as one of our executives likes to put it. And 3 to 7 years is enough time to be able to execute it. Yeah, no, not for us. We'll look at it just like, many other opportunities to say, how much what are the dollars that need to go in, and what's the probability that that process is going to go well, right? And what are the dollars ultimately that we're going to get out at the end of the day, assuming we invest in this new equipment. So I think for us, that's something others may feel differently about that, right? And I think where it does get challenging is you have to continually reinvest heavy dollars in new equipment, right? You just ultimately may not realize the return that you like, though we've looked at many of those businesses as well, good cash flowing businesses that just require a lot of reinvestment that still have good cash flow at the end of the day. So we just would look at it like any other, execution or implementation risk and make sure that we're going to earn an appropriate return for the capital that we invest. But if we're going to buy a business and, 2/3 of the money, 3/4 of the money is going to go to recapitalize and, get some money, some liquidity to some of the partners, and then a quarter is going to be there for growth going forward in the form of new capital equipment. I mean, we look at that all day.
So I mean, I think that can be the case, but I think from our perspective, sometimes it's hard to build a strategy around selling to strategic because if you think about running your own business, right, there might be a day where you say, look, I'd love to buy another company, and there might be a day where you say, look, I don't want to. So potentially it could be better, but the other problem there is, look, generally private equity company, more often than not, they're partnering with existing management and growing it, whereas strategic, again, more often than not, is going to be, potentially eliminating management. So, uh, yeah, absolutely, absolutely, and I think that's a great point too. I mean, when you're thinking about the business owner's situation, a lot of times, they have all their eggs, financial eggs, in one basket. So, they may have all sorts of growth plans that are interesting and exciting, but they don't want to execute on them because their sort of risk reward profile, it's a little bit too risky. So, look, what can be fun is, they get a nice check, they roll over money, and then with hopefully new executives, you execute on a growth plan that they may already be thinking about, but not have executed on just because of their sort of risk profile.